How to get rich in the second half of 2022. Our high risk total return year to date jumps back up to 32.5%. I believe the highest we've had this year is 50%. And that's after more than tripling investors' money last year. Here's how we recommend you invest $10,000 right now. The current risk calculator is calculating this. Now, if you're a paid member, you can actually type in the exact amount of money you want to invest. It'll auto calculate the number of shares. You can see our table format separates the investments into defense for deflationary investments and then offense for inflationary investments. On the defensive side, we have two tickers, UVXY with 70 shares, and then TMF with 148. UVXY is a stock crash play, while TMF is betting that interest rates are going to fall on the long end of the US bond market. Right now, combined, that's about 28% of the total portfolio on the defensive side. On the offensive side, we have four tickers. ETHE, that's the Grayscale Trust, which gives you exposure to Ethereum, our favorite tech asset, which is set up to basically compete with Microsoft and the entire financial system, just to summarize it. Then we're long FNGU. It's 12 gigantic tech companies who are taking over the world, leverage ×3. And then we're hedging against inflation due to the conflict in Europe, as well as bad policies in the US by betting on the price of oil and natural gas going up with tickers NRGU and BOIL. Now, BOIL's been ripping higher because Russia is cutting off natural gas to Europe as we speak, as the war is about to intensify. And we'll cover all this and more, but we're looking at 218 shares of ETHE, 105 shares of FNGU, 4 shares of NRGU, and 26 shares of BOIL. Now, I do think we could see BOIL break to new highs, but we'll probably start unloading some of that exposure in the coming weeks. And we're actually expecting Ukraine to make a big offensive push in August, and it looks like Russia's next big attack will be first to defend against that, while it makes incremental moves along its current successful attack. And then it looks like they're getting ready for a huge drone attack. They got a bunch of drones from Iran, potentially in September, assuming this war doesn't come to an end sooner. So to sum it up, we're 70 shares UVXY, about 8% of the portfolio, 148 shares into treasuries, about 19% of the portfolio. TMF, we're loading up on Ethereum with ETHE, 218 shares, representing 24% of the portfolio. We have 105 shares of FNGU, which is about 9.5% of the portfolio. 4 shares of NRGU, that's the top 10 big US oil and gas companies who have a monopoly with the way markets are set up, representing 14% of the portfolio. And then we're probably going to start taking some profits soon on BOIL, but I do think it could go to new highs if there's not peace negotiations very soon. And I think if Ukraine has success with its offensive attack, this is all going to get way worse, and we're going to be holding BOIL and NRGU much longer. If their offensive attack is crushed, which so far everything they've done offensively has been, then perhaps we're closer to a negotiation here. So that's why we're looking at markets. Let's break it down play by play and look at a lot of data and charts. Step 1, buy 70 shares of UVXY, the crash insurance hedge. In 2020, in March, when the whole world went locked down, oil went negative, stocks cratered about 30% in a month. You can see in this chart exactly 25% decline in SPY. UVXY went up over 1,000%. So a small position in this crash insurance can really save your ass. We always have it in our portfolio. Now, why should we be worried about further downturn in the markets? Well, first of all, Wednesday, we have an important Fed meeting. They're anticipated to hike interest rates 75 basis points and start to give us some future guidance that they're going to slow down and even pivot by next year. So if that's the case, DXY, the dollar index, probably falls and stocks are okay. They come out with a 100 basis point rate hike, talk about a 75 rate hike in September, and keep this very hawkish tone up, well, the dollar is going to go up and cause problems globally. So a lot of risk there. The other important thing is we have critical earnings Thursday and Friday, plus we have the GDP for Q2 for the US, which is most likely going to be negative, indicating we're now in a recession. So a lot of reasons to be concerned about that. Here's a chart showing all the market crashes that have been caused by the Fed hiking rates too far. I want to point out it doesn't circle all the times the Fed's pivoted and prevented significant crashes. So if the Fed's about to pivot, then we're not going to be needing a whole lot of UVXY. Most likely we want to get aggressive in Ethereum. Here's a look at some of these drawdowns in history. So we can see there's been in the Great Depression, World War I era, World War II era, you had a lot of bad times in stocks due to deflation or inflation. And so back to back, you get some really nasty stock market returns from 1900 all the way to 1960s. Of course, after the World War II event occurred, we had a beautiful stock market return. The next big bad period of time was the 70s, where we had uncontrollable inflation for a decade, which I do not see in the cards right now. And you had this beautiful, beautiful bubble up in markets as we've grown debt just massively. And so that leads us to current day. Step 2, buy 148 shares of TMF. That's the deflation hedge. If we think the global economy is slowing down, which it certainly is, treasuries are a beautiful play. So this is the TLT chart. You can see to break to new highs, we've got to go to around 170. And I certainly think that is in the cards over most likely about a 4-year stretch. So in general, as long as we can get energy and food costs coming down, I believe we have a beautiful 4-year stretch for the bond market to be extremely profitable investment. And we're using a leveraged version of the TLT, which is TMF, to get more bang for your buck. And this is why we've had so much pain this year. The bond market crashed faster and longer than ever before in history in 2 big swoops over a 2-year period. And it's caused significant pain in global markets everywhere. Now here's a look at the TLT in the 1 month, rising 5%. So I do think the bottom is in on the TLT, and it's going to be a nice slow ride to new highs over about a 4-year period, which is when I think we're also going to see a top in cryptocurrencies, which should break to significant new highs. So it looks like this cycle is really just getting its legs going right now, and that inflation is going to be coming down. And the only real wild card is going to be the energy and food problem caused in Europe. Here's the investment grade bond market. You can see this is recovering. This is what feeds all your big tech giants with debt. And then the one that's been really slow to react has been the junk bond market, but it's also now recovering over the last month. So everything's looking good in bonds, which means our setup moving ahead should be very, very good. Now, this is the 3-month treasury, and you can see it's gone straight up, one of the fastest moves we've ever seen in history, and perhaps the fastest, but it's starting to top off. So this is one of the bonds that's been still aggravating markets. We look at the 2-year, it went straight up ahead of the 3-month, and it's actually started to flatten out as well. The 10-year, which we can see has had a long-term channel of going lower and lower, is already negative on the last month. So the long end of the bond market's already predicting the Fed's going to have to pivot here and lower rates into the future. The short end is anticipating that the Fed will have to hike rates in the short term to fight off the inflation. So the 2 sides of the bond market are now in competition. Here's the 30-year, which has also fallen slightly less than the 10-year. Now, in other bond markets globally, we can see the Japanese 30-year bond market had been under pressure with rates rising. In Japan, investors were shorting the currency and bond market with hundreds of billions of dollars. And Japan's been fighting that with yield curve control. It's caused their currency to devalue, but it's protected their bond market. If we're about to have a deflationary move in the economy over the next year, there's going to be a huge short squeeze in both the currency and bond markets in Japan, which I see extremely bullish for technology stocks, especially cryptocurrencies. We're seeing the same pattern developing in the German 30-year bond. They're facing inflation and really their producer price index just extremely high. Their manufacturing sector has gone into a recession. And this is all, again, because of the war in Europe. So I think there's going to be a lot of motivation to start to roll back sanctions and try to create a truce here as we come closer to winter. We're going to look at the gas supplies in Europe are way too low as Russia's cutting them off. Here's the Italian bond, which has been causing a lot of problems in Europe, also starting to stop rising. So it's really just about everything. Now, as interest rates rise, it's made the dollar go up. This is all in the anticipation that the Fed is going to be hiking rates. Now, again, we're looking at most likely the last aggressive Fed hike this Wednesday, and probably forward guidance saying that they're going to start to cool it off by September, leading into midterms. So this should get the DXY to finally stop rising. Because if it doesn't, again, global debt denominated in dollars becomes extremely expensive to service for foreign countries if this trend continues. So the best returns we've seen in cryptocurrencies have been these short little periods where the DXY index has fallen, specifically in a very similar setup to what we have right now. Here's the euro going below $1, I believe for the first time in perhaps history. This made a lot of news, but likely we're going to have Europe trying to tighten as US starts to loosen, so we can reverse that trend here. Here's the Japanese currency losing about 20% of its purchasing power against the dollar in the last 6 months. Again, this trend could quickly reverse here if deflation's coming in, and the same thing over in China. Now, signs that deflation is coming in. Lumber futures are down over 50% from their recent highs. This has been very predictive of prices in general. Copper futures are crashing quite precipitously. This might start to rebound if China does some massive stimulation to protect their housing market, but so far signaling lower prices ahead. You can see we have started to get a bottom in copper futures, and this is likely due to China trying to reboot their economy. The Baltic Dry Index is the cost of shipping commodities to various continents, also about 65% below its recent high. Wheat futures, even with this huge problem of exporting grains from Ukraine and Russia, have still crashed about 40% from their high. Here's the CPI. You can see last time we had it at this level was in the 70s and early 80s. But the trend is basically pushing this lower and lower because we have less and less people who can work and generate income, which is the main inflationary pressure. We've also had a reduction of birth rates in all the key countries. So there's a very big deflationary pressure in general hitting global economies for the next several decades. Here's the CPI in a year-to-date 1-year chart, and this is the core inflation. I believe we have popped to the top and are going to fall from here. Other economic data, we have the Chicago PMI falling, still in positive territory, but heading to below 50. Michigan consumer sentiment is at an extremely low level. People think the inflation is just going to get worse and worse and worse. This has typically been a great time to buy stocks when you get to this level of negative sentiment. And again, the inflation's clearly getting ready to fall. We're starting to see initial claims pick up. So people are starting to file for unemployment. The 2 and 10-year spread is headed towards an inversion again. This typically is a great time to buy tech stocks. Now, if this were steepening, we'd actually be wanting to bet that we're heading towards some sort of stock crash. So we're not having a steepening of the yield curve. Now here's the labor market dashboard photo. And so the economy is still really strong. We're just seeing a slowdown. And that's a key differential. A slowdown could be a Goldilocks situation for the stock market. We still have a massive amount of job openings relative to people looking for work. And then again, we're still seeing strong labor force participation rate growth, as well as strong new jobs added each month. Here's a look at the falling core inflation rate, which did drop only to 5.9. I need to update this chart in the last update, but I believe it will continue to fall here. PMIs in Europe are all in negative territory, indicating that we have deflation coming in. The used car index, which had been pushing the inflation for much of the year, is now in negative territory. And we're actually starting to see a bunch of defaults on loans. So in the next 6 to 12 months, the amount of cars available for sale should be dramatically up. We're also seeing a huge reduction in housing prices and cancellation of orders. So the housing market's cooling off quite rapidly here as well. So the Fed's really at a risk of over tightening and making all this data get far worse. If they pivot now, it could be very good timing. Container ship rates have been falling for several months, and the bond market's now predicting the Fed's not going to be nearly as aggressive as their dot plots are showing. And that's why we're seeing the long end start to discount what's happening on the short end. Some other key commodities: soybeans down significantly, wheat down significantly, corn down significantly. And in this chart from Fidelity, we can see every single bond market's been falling for several months. The high yield junk bond market was the last to make its big move. This chart's just looking at some of the housing markets that are cooling off, and certainly there's a huge slowdown happening in the housing market. So if rates are falling, but the economy is not going to go into a mega crash, we want to be long tech stocks and cryptocurrencies. And so those are our positions that we're going to get more and more aggressive into by taking profits on NRGU and BOIL over the next month or two. And we'll probably be taking profits on BOIL sooner than later because it's about back to a new high. We'll look at those charts momentarily. Buy 218 shares of ETHE. This is the ultimate growth product. I equate it to a ripoff of the US financial system and Microsoft. Okay, so it's a beautiful product that competes with both those markets, huge market cap potential, and a lot of successful applications already designed on the Ethereum operating system. This chart is the big bounce we've had in Ethereum, suddenly front running the rebound here. Here's a look at Ethereum long term. I think the next stop will be in the 10 to 20,000 range in about 4 years. So it's going to be a really fun ride to be long this asset. Here's ETHE. It's up 36% in the last month. It was trading at a huge discount, about 35% below its par value. What that means is the Grayscale Trust stock price times total outstanding shares was worth 35% less than the Ethereum the trust actually owned. So very funny that initially this traded at a premium. Over the last year and a half, it's been trading at a great discount. So still a good time to buy ETHE. And if we look at the bigger crypto market with Bitcoin, it's gone below the 200-day moving average 4 times in history. It's always been a good time to buy the dip. 2015-16, we did bounce off that twice, so you could have been scared, but then you shortly after had this massive melt up from 2016 to 2018. RSI signaling to buy Bitcoin. We had the worst month ever with all sorts of centralized exchanges and massive hedge funds blowing up. So time to reallocate capital into cryptocurrencies aggressively for the rest of this year. This is looking at the quarter returns, worst in history as well. So it was just a huge, huge inflation bond market crash that caused so much pain in cryptocurrencies. But again, what's the main reason you want to load up on cryptocurrencies or stocks in general? It's because you believe governments are trapped and they're going to grow debt exponentially in order to deal with a declining labor force, declining population, as the main trend, plus politicians who've given out so many promises that they can't reward with actual tax receipts. And you can see the growth of debt is growing exponentially. And there's really no way to change it without completely overthrowing governments. And this is a problem for every major economy. Step 4, buy 105 shares of FNGU. This is the big tech giants times 3. Now, these companies have been around for decades, so they're much safer investments long-term and much more mature market caps. The cryptocurrency we're big on, Ethereum, has only been around for about 8 years, so it's much more new and has much less adoption. So we like to be a little more aggressive on that play than the tech giants. But this is the same idea. FNGU is highly correlated to ETHE, and it just helps diversify our portfolio. So here's a good sign if you want to believe that we're heading into a Goldilocks situation for stocks. US Amazon Prime Day retail sales hit a new record high in 2022. And it's really just the very poor section of America that seems to be slowing down its activity with purchases, because they're really getting eaten away by the gas and food prices. Here's consecutive days with the NASDAQ hitting a new low. We hit a high last seen in 2008, another signal to buy the dip. Here's a chart of FNGU. And again, I see this breaking to new highs over about a 4-year stretch with a similar expectation on bonds, tech, and crypto. Now, if we look at other stocks, if you're in our safe growth strategy, we have exposure to SPY with UPRO. So it's SPY times 3. We're getting that same bottoming out chart. The NASDAQ, if you're in our safe growth strategy, you have the triple Q, same idea. This just gives you about 150 stocks, and it's not as concentrated in a handful of companies that tend to get the call option activity. That's what FNGU specializes in. We have got a big position in emerging markets with EDC in our safe growth strategy, seeing a similar bottoming process here on EEM. We're watching the European market for signs of contagion from the war that could create a global depression. So the best example of this was the Great Depression, and that's from World War I, when the whole world wanted reparations from Germany to the point that it bankrupted Germany, and then it spread through the entire global economy and created the worst stock crash in history. Now, we've got better tools to fight that, which is printing lots of money these days, but something we're keeping a look at. Also, Ray Dalio has huge, massive short positions on German and French companies. So we're looking for this to spread, but it's got the same negative return as all the other indexes thus far. Some alternative energies that are probably gonna get more and more investments, especially due to this conflict, pointing out our reliance on harmful countries like Russia to US hegemony, is uranium. So we're long uranium. We've seen this trading sideways here, but also down 19% year to date. And we're long rare earth metals, specifically lithium and cobalt. So these are the main raw materials we're going to need to slowly but surely remove reliance on oil, gas, and coal. And this is going to be a very, very slow, long process. So expect to be long REMX and uranium in our safe growth strategy for probably the rest of your lifetime. It's going to take decades to make this transition. Some specific stocks we're looking at: Amazon bottoming out here, showing the same pattern as the index. Apple down less than the indexes, only down 10%. And Alibaba, which has been going down for a year and a half, finally looking like it might be bottoming out. This is the Amazon ripoff. Now, tech stocks are not nearly as irrationally priced as we've seen in other crashes back in history. So these tech giants actually print money like nobody's business. In this chart, we're actually looking at the 12-month return from market troughs during recessions. It's really important to note that the stock market will bottom out before the recession officially ends. So if we're in a recession right now, which we'll learn on Thursday that we most likely are, now could be a very beautiful time to be getting very aggressive. And unless we're going to see a huge crash in earnings and the inflation remaining too sticky, forcing the Fed to be more hawkish, this should be the bottom. So we're getting more and more aggressive here. Insiders are buying the dip in the NASDAQ at a very rapid pace. This has typically been a good signal. Here's non-farm payrolls still coming in nice and strong. So these are the numbers that are good, but not too good. Banks continue to grow credit. Consumers continue to grow credit at a very rapid pace. And retail sales, although slowing down, are still hitting new highs every single month. The balance of trade is slowing down, but still highly negative, meaning Americans are importing lots of goods. And China is rebooting their economy. We can see imports and exports are starting to pop back up for China. And their PMI, which almost went to 35, is jumping right back up to 55. Chinese exports heading back towards record levels, showing that, again, the global economy, while slowing down, is not dead. Step 5, buy 4 shares of NRGU, the inflation war hedge. So they've managed to get oil from as high as 130 approximately down to 100, but they've done it by just dumping the strategic reserve. So this is going to have to slow down. And as long as oil's even above 90, I'm very bullish on NRGU. So we're going to hold this until there's a major resolution in the war, at which case I could see oil falling into the 80 range. And we would want to get out of the way of that, then buy the dip back into NRGU. Here's a look at NRGU, which we made a lot of money on this year. We got out, we bought back in, and it's going right back up for us. So a lot of room to move on that. Here's a look at the price of oil. Again, it's slowed down. This is good for the bond market, but it's still at a level that's extremely profitable for the big US oil and gas companies. Here's one of your big positions in NRGU is Exxon. So yeah, it could very likely go back up to that $100 price and even break into new highs. Okay, so what's going on with the war? It looks like in general, we're about to see a offensive down by the ocean by Ukraine, and it appears Russia is preparing for that. And then in September, it's leaked that Russia is going to do its next big push with a bunch of drones. So that's kind of where we're at here. If Ukraine is successful, I expect the NRG and oil positions to go straight up and for us to need to hold it much longer. If Ukraine is not having success, I believe we're going to see a lot of pressure to start removing sanctions and negotiate peace. So we'll have to watch that play out here. So far, there's really been zero good news for Ukraine over the last month. Really nothing good to talk about. Meanwhile, to really make the sanctions work, the other thing we need to be aware of would be the US trying to sanction India and China, as well as Turkey, from picking up Russian oil. Without that, the sanctions are essentially worthless. This chart's just showing you it's a good time to buy the dip on commodities, which is right when we did. And again, we still have a healthy economy. So even though we're seeing some demand destruction in gas, we're still seeing a very strong economy with a lot of spending here. And again, there's twice as many jobs open as there are people looking for work. Step 6, buy 26 shares of Boyle. This shows you the ridiculous price of natural gas in Europe compared to the US. It's very complex to ship natural gas from America to Europe. And there's a limitation to what we can do for it. The war has been extremely beneficial to LNG producers in the US. So again, if the war is going to start pulling back sanctions or end, we definitely want to get out of Boyle. If we look at the price of Boyle on this chart, we got in early this year, sold at nearly the top, it went a little bit higher, and then we bought back in after it had crashed. Had a tiny bit of drawdown, and now we're up significantly. So look to start selling some of that. If the Ukrainian offensive move is successful, this could go parabolic because natural gas could be completely shut off to Europe in response. Again, we're at nose bleeding prices, so we got to be careful with this play and probably start taking some profits very soon. Here's the problem for Europe. They don't have much gas stored. They're shutting off, they're trying to reduce consumption, and they're creating massive protests throughout Europe. three big leaders in Europe, UK, Italy, and France have had tremendous political disasters for supporting the war, and most likely are going to have to start looking for peace here. Otherwise, we could see revolutions in other countries. Here's a look at the electricity in Germany, just up insane from 50 per megawatt hour normally to now 300. Coal usage is jumping back up, and we're having protests all over Europe. So that's the big picture. Now, what's the main reason why we think inflation is going to slow down here? Jeffrey Gundlach nails it. Dear Mr. President, please admit excessive stimulus and lockdowns were significant drivers of inflation, and pledge you will not support either of these policies again. And so far, the Senate's at least not allowing that to happen. Okay, very good. So I'm going to go ahead and jump into our track records. So the high risk portfolio is sitting on a massive 26% gain in July, 32% return year to date. Last year we had a 233% return, total return. Our safe growth strategy is now down 23% year to date with a 5% return in July after returning a 25% return in 2021. If you're doing 70-30 combo, you've got a 7.5% return in May and you're up 12% year to date. Now, if we go into the membership area and look at the risk calculator, it's really neat. This is only for paid members, but you can punch in your investment total and it's going to automatically tell you what to buy. Now, again, what we're expecting is to sell NRGU and rotate it into GBTC, triple Q, and maybe some bonds for safe growth. And timing on this is probably in August or September based on what's happening in the war. The high risk portfolio, we've already made a huge gain on Boyle. So it's pretty soon I'll be taking some profits on that and most likely rotating it into Ethereum and FNGU. We've already got a good treasury position for high risk. So that's what we're expecting on the trade alert front. Okay, very good. So I'm gonna go ahead and do Q&A now and take any questions. Okay, Bill says, any questions on BRIC with the new currency? Yeah, so Iran, Brazil, China, Russia are trying to remove their reliance on the US dollar. So it's probably like a 50 to 100 year play before the dollar's dethroned. So I don't see the dollar losing reserve status, nor do I see China attacking Taiwan anytime soon. But yeah, that's certainly what's happening here. Oh yeah, and Saudi Arabia too, Gary says. Elliot says, do you think if the Fed does 100 basis point rate hike, will the S&P sell off? Well, they already leaked that they're not going to do that, so I don't think they will. And it would probably be more important. I think their forward guidance on what the path is in September is going to be more important than what they do today. I think everyone's expecting either 75 or 100 basis point rate hike. They already leaked that they're going to do 75. Dennis says, does a high dollar keep Bitcoin and Ethereum down? Yeah, in general, yes. I want to note though, Bitcoin's returned 1,000,000% with the DXY going up over the entire lifespan of Bitcoin. So not necessarily, but in general, it's not good for the dollar to go up relative to the pricing of cryptocurrencies. So yeah, the forward guidance on what's going to happen in September is probably the most important. We definitely want to hear them talking about slowing down the rate hikes, that they're seeing a slowdown in the global economy. Yeah, you're gonna have to do a little more advanced math to actually calculate that rock. It's not as simple as that. Okay, Armin says, what's your, well, Amazon Prime just had record sales. So yeah, I think the earnings are gonna be better than expected in general. So yeah, we got big earnings on Thursday. Harry says, when do you think EDC will surge? Probably as the war wraps up, because that's when we're going to see inflation fall faster, the dollar fall faster. And that could be coming up soon here. Yeah, DXY is the worst enemy for the global everything, as well as the bond market going up. But we're already seeing everything come down, so DXY will come down with it. And it is already falling. Its high was 108, and we're at 106, so it's starting to cool off. But yeah, what would make everything get pissed off again? You'd have to sanction Turkey, India, and China from buying Russian oil. That would do the trick. That's probably the only thing that would disrupt the flow of how the markets are moving now. Armin says, does Japan's currency affect the dollar a lot? Yeah, so the main currencies are the yen, the euro, and the dollar. Terry says Trump wanted a stronger dollar, but it doesn't seem to be good. Yeah, at this level, it's not good. We don't want a super weak dollar, but we don't want a super strong dollar. So I think we're going to see DXY fall to about 89 in about 4 years. And then we're going to see interest rates flirt with much lower rates than they are. Maybe we don't break into the lows of the pandemic unless there's some sort of catastrophe. And so I'm expecting, in general, about a 4-year cycle to be long tech and bonds in general. And that the extreme moves in energy were aggravated due to the Russia-Ukraine war and really accelerated what we were expecting to happen in the price of oil and energy companies. Rich says, do I think mortgage rates will fall? Yes. Yeah, I think we're going to see all interest rates and all bond markets fall for 2 to 4 years, probably 4, unless there's some sort of catastrophe that creates a really big slowdown, like like locking down the whole world because a virus has been released and policymakers want to shut down everything. Rich is saying the lower interest rates will reignite real estate. Well, the prices of real estate are way overdone. So yeah, I think this will help stop the crash that's starting to develop. I'm not predicting real estate prices are going to go back up anytime soon, though, because that was just greatly overdone with interest rates super low. All right, guys. Well, we'll be back on Monday of next week. If you're in Rebel Dividends, we have a webinar tomorrow. And probably in a week or two, we'll start selling off our Boyle position and rotating that into ETHE for high risk. So thank you guys so much, and we'll see you back tomorrow if you're in the Rebel Dividends private equity, or we'll see you back next Monday if you're just in Portfolio Builder. So thank you so much for your time, and we'll see you back next week.